The global reserve currency system is undergoing a critical transformation. In its latest report dated January 21st, Global Foreign Exchange, Commodities, and Public Policy, gold remains the dollar's biggest challenger. Morgan Stanley directly identified the core development. Gold is quietly displacing U.S. Treasuries to become a central force challenging the U.S. dollar's hegemony. More strikingly, the scale of gold reserves held by central banks globally has reached a historic milestone, surpassing their holdings of U.S. Treasuries for the first time since 1996. Examining the current state of the U.S. dollar reveals a broad yet gradual decline. IMF data for the third quarter of 2025, released last December, shows the dollar's share of global central bank foreign exchange reserves fell from 57.9% in Q3 2024 to 56.9%. The shift isn't confined to reserves. The dollar's share of global corporate foreign currency bonds issued in 2025 is also decreasing, while the euro's share gained 2.5 percentage points. A key point to note, however, is that the dollar's foundational role remains unshaken. In critical domains like global foreign exchange trading and SWIFT settlements, it retains absolute dominance. Its erosion is a protracted process, and no single currency is poised to replace it directly in the near term. Contrasting sharply with the dollar's gradual ebb is gold's rapid ascent. Morgan Stanley defines the 2022 Russia-Ukraine conflict as a pivotal turning point for global central bank reserve strategy. Soaring geopolitical risks spurred a frenzied gold-buying rush among nations, causing annual net central bank gold purchases to double and persist at a high level exceeding 1,000 tons per year. This buying spree has directly produced a milestone. The total value of gold held by foreign central banks, around $4 trillion, has for the first time exceeded their $3.9 trillion holdings of U.S. Treasuries. Moreover, a World Gold Council survey shows 43% of central banks plan to boost their gold reserves over the next 12 months, with none planning to sell. Gold accumulation has thus transitioned from a short-term operation to a long-term strategic posture. At its core, the central bank gold rush is not motivated by higher returns, but by seeking security in an uncertain world. On one hand, rising geopolitical risks and the weaponization of financial sanctions have made over-reliance on the dollar system excessively perilous. Countries repatriating gold for domestic storage are fundamentally reasserting their financial sovereignty. On the other, the U.S. high debt problem has fostered market skepticism about the dollar's long-term purchasing power. Gold, as a non-liability asset, independent of any government's credit, has emerged as the premier tool for hedging sovereign credit risk. What is termed de-dollarization is, in essence, the strategic diversification of national asset allocations. Furthermore, gold's market fundamentals operate on logic entirely distinct from typical commodities. Even with prices at record highs, gold supply cannot expand quickly. The exploration and development cycle for newly mined gold is intrinsically very long. Adding to this, central banks have transitioned from net sellers to net buyers, permanently removing a substantial portion of supply from the market. Gold supply is essentially inelastic to short-term price movements. This supply-demand paradigm makes Morgan Stanley decidedly bullish on gold, explicitly forecasting a year-end price of $4,800 per ounce with upside risks. Consider that gold prices have already surged 64% in 2025, their strongest performance since 1979. The core drivers of gold prices today are no longer short-term supply-demand dynamics, but sustained central bank purchases, ETF investment, and strategic allocation demand. These sources of demand create a solid base, rendering gold prices increasingly decoupled from traditional economic cycles. Looking forward, the tempo of this trend will largely hinge on U.S. policy direction. Its fiscal discipline, trade policies, and deployment of financial sanctions will all impact the pace of global de-dollarization. Excessive U.S. reliance on sanctions would only hasten the search for alternative systems. Yet, the dollar's incumbency advantages remain a powerful, slow variable. The depth and liquidity of its capital markets are unrivaled. Consequently, the future will not involve gold or a single currency supplanting the dollar. Instead, a more diversified international reserve system is likely to evolve. The dollar's share will decline slowly. The shares of the euro, renminbi, and other currencies will rise moderately, while gold will steadfastly serve as a system stabilizer and strategic safe haven asset. For investors, the imperative now is to watch two key signals closely. First, U.S. policy shifts, especially regarding financial sanctions and fiscal policy. Second, the rhythm of global central bank gold buying, the core pillar supporting gold prices. Gold has become an essential hedge in investment portfolios, and its ensuing volatility deserves significant focus.